Welcome to the Lance Roberts Podcast today here at realinvestmentadvice.com. Our special guest today, and I'm truly just honored. I've been following Bill Fleckenstein at Fleckenstein Capital since 1999, really when I was just a youngster in the business, it seems like. Of course, that was decades ago. And now I'm this old guy still following Bill Fleckenstein. And, of course, his views are always great, and he always has a very keen insight into the market. So I wanted to talk a little bit today with Bill about what happened yesterday. You know, Jerome Powell seemed to come out yesterday and really, after just, kind of a bit of a rough patch in the market this year. I mean, we've had a couple of 10% corrections, but doesn't seem to be anything major at this point, has all of a sudden backpedaled on his view that, well, we were far away from the neutral rate in October. Now we're right up to it. What do you think he was really saying yesterday?
Well, he was acknowledging the fact that in sum, world economic activity, which impacts the U.S., is weaker than they might have guessed, and he was trying to calm the markets down because they are worried about, pre-programmed rate hikes no matter what. Mm-hmm. So what he was trying to say is, well, they don't have, we don't have to have them be pre-programmed. We could look at the data. He didn't say it like that, but right. He was just backing off the thought that no matter what, they're going to be hiking a bunch, and that's really all he was doing, in my opinion.
Do you think the markets misinterpreted what he said yesterday?
No. But the markets didn't misinterpret him, but the market doesn't have seems not to grasp the subject that is more important, which is what they do with the rate hikes. I mean, it matters a little bit, but it means nothing relative to the fact that they are in the process of shrinking the balance sheet. QE, 3 rounds of QE and Operation Twist,
right.
And QE on the part of the other world central banks is what got the market to where it was, and put rates where they were. Now they're in the process of trying to reduce their balance sheet. The market will not be able to take that. The reason the market is cracked is because the amount of free money that had been out there had moved the markets to a high enough place, and there isn't enough anymore, and it's going the other way, and that is not going to change. The stock market is going to go down until the Fed stops QE and stops QT and starts QE again. Now, I don't know how long that'll take or how deep down that decline needs to be, and there'll be stages along the way where they back off various ways. But the market's going to get no help from a monetary policy standpoint until they actually switch from QE to QT. There won't be any free money. The rest, it'll just be verbiage. And of course, there's other verbiage that's bouncing the market around. There's the trade de-escalation hopes that resurrect themselves about every third day, and we're going to this weekend.
Yeah.
And then there's also, so I mean, if you listen to talking heads, they talk about China and the Fed. Well, the Fed has already now acknowledged that they probably aren't going to be as militant as people thought they were going to be. But that won't fix the problem the market has.
So let me ask you, that brings up an interesting point that you bring up. We're going into Friday this weekend, of course, is the G20 summit. Donald Trump is going to be really kind of front and center with President Xi over, trying to figure out some type of trade deal. One side of this coin has been Donald Trump being very hardline on China about trade. But at the same point, do you think Donald Trump now backs off of his trade position? Donald Trump has been very focused on the market as a representation of his success as a president. With this kind of turmoil we've seen this year, of course, he was after Jerome Powell, saying that the Fed was out of control. Now it seems like Jerome Powell maybe backed off a bit. Does he back off his stance with China?
I have no idea.
At least that's honest.
Look, he's wildly unpredictable.
Yep.
And he can change his mind 15 times, and it's impossible to know. Anyone who takes a position based on what they expect to happen this weekend, is either totally clairvoyant or foolish. because there's no way to know what's going to come out of it. I mean, what will most likely happen is nothing, and they'll pretend like things are better. Now, maybe we'll throw them a bone. Maybe they'll throw us a bone, and they'll agree to talking about it. But nothing of any consequence is going to occur.
Well, and I guess so from a positioning standpoint, and look, you've been in this market a long time. You've been through the .com crash. You've been through the 2008 financial crisis. Here we are a decade later, still here. Which is an accomplishment. I don't put that lightly. To be here in the markets this long is an accomplishment, because after two major bear markets, a lot of people have gone. So the fact you're still here is a testament to your long-term success.
It's not the bear markets that have hurt the people with experience and a little skepticism. It's been the QE and the insanity of the central banks.
Well, and again, and you brought that up a second ago, talking about the fact that the Federal Reserve is in the process of reducing their balance sheet, and you also made the point that at some point they're going to come back and do QE again. I guess that's the real question, that when we look at what the Federal Reserve said yesterday, that we're closer to the neutral rate than we were back in October. Okay, so if that's the case, we're around 2.25% on the Fed funds rate right now, which means that economic growth next year is looking to slow down towards that level if we're close to that neutral rate. Well, that doesn't give the Fed a lot of room to lower rates if we get into a recession, right?
Oh, you're acting like these people actually know what they're doing. They don't have any idea what's going on. They missed it. I could regale you with quotes. Bernanke didn't, right when subprime was about to implode, he said it was contained before it had really gotten going. I could show you tons of quotes about Greenspan, and they don't have any idea. They think what they do works. It doesn't. And the big battle between the proponents of QE and the opponents of QE is that who oppose it and think it's bad policy say that it is not a policy, because a policy that you can't reverse is not a policy. That you cannot leave NERP, ZERP, or QE, which is why we're already having a temper tantrum when they're rates are as low as they are, because the underlying problem is the reduction of the shrinkage of the balance sheet. So I don't care what they say. They don't know. They're going to respond to events. And the events they're going to respond to are lower stock prices, because the economy will go with the stock market. When you create these massive bubbles, they impact the economy as well. And so when the bubble stops inflating and starts deflating, then it seriously impacts the economy. Remember, up until say 2000-ish, or maybe late 90s, the economy was the stock market was a reflection of the economy.
Right.
But starting in about the 98, when Greenspan really lost his mind, the stock market has been dragging the economy higher, and in this particular go-round, that is specifically what the Fed set out to cause to happen.
Right.
Bernanke's fancy word for it was portfolio balance channel. So they specifically tried to boost asset prices to help the economy. So they own this bubble, and they're going to tend to defend it. Now, they wouldn't say it that way, and they think that their policies work, therefore they think they can end it. That's why they want to keep on the rate hikes, because it says to the world, look, our policies worked, and now we're ending them, going the other way, and this proves it. Well, the policies don't work because they're not going to get very far in the exiting of it before things implode on them. But again, we're talking about something that's never happened before. QE never happened before, QT's never happened before, and we don't know how long it takes for events to impact the market and the economy, and for psychology to change. So there's a bunch we don't know. All we do know is that I don't know that we know this, but this is what I believe is the stock market's going to continue to decline until the Fed backs off. Now, that doesn't mean we can't have a rally into year end or for 2 weeks or whatever. I don't know. But anyone who got excited simply because the Fed said, maybe we're closer to neutral, and bought stocks, I think is going to wind up losing money.
We're talking with Bill Fleckenstein, Fleckenstein Capital. Be sure and get by his website, fleckensteincapital.com, and subscribe to his newsletter and his website where you can ask Bill questions about whatever you want to talk about. That's what he does there. Of course, Bill Fleckenstein, fleckensteincapital.com. We'll be right back. More with Bill right here at Real Investment Advice and, of course, The Lance Roberts Show, which, of course, you can subscribe to at our YouTube channel, the YouTube channel, youtube.com, The Lance Roberts Show, lancerobertsshow.com. We'll be right back.
Got a question for Lance later? Ask now at realinvestmentadvice.com.